has just accelerated the Treasury sell-off that we have seen to start the year, which is one of the worst ever beginnings for bonds. What's the market interpretation of that jobs report?
Well, I think the market didn't look at the headline number. It looked underneath the surface as it usually does. And although you referenced the 199,000 jobs being a little bit weak and below expectations, when you look at the revisions within the report for both the October and the November data, you got almost another 140,000 jobs. So you put that together with the jobs print we got, maybe we get closer to expectations if you look at those revisions. And a lot of people think that that number from December may be revised upward. But the bond market, I think, looked at the average hourly earnings data. And if you look at the month-over-month increase in wages once again, I think that was the thing that the bond market continued its sell-off, because it looks to see that it's going to allow the Fed to continue on its path of tapering, as well as eliciting liftoff from these low levels.
And that wage number was strong, 4.7% jump from where we were last year. More than expected. Yeah, and interestingly, Jeff, it expanded beyond leisure and hospitality, which shows that it's a little bit more persistent and widespread. We saw it in wholesale trade, a big jump in wages, financial services, education, really across the economy. What does that do to the inflation picture?
Well, it continues to keep pressure there, and I think that's why it emboldens the Fed at this point. And also, Sarah, there was a revision upward to last month's wage number, to where the year-over-year growth last month was 5.1%. So it is very robust in terms of that participation. You couple this with the JOLTS data we got earlier in the week, which is the job openings, very strong in the quit rates across various segments. Yes, the most was within leisure, but there was a lot of white-collar workers as well that were quitting jobs. So this continues to keep pressure on inflation. And so we get CPI next week. We expect it to print with north of a 7 handle, likely to be about 7.1% or so. And then we continue to see pressure over the next couple of prints as well. So what I think this does is this allows the Fed to continue with their rhetoric. They're going to try to hike rates. The market now has a March hike almost completely priced in. And I think that allows the Fed to do so. The market is saying it's okay to do so. We're already prepared for it. And so I think it just allows the Fed to really accelerate this path of rate hikes that they really want to do at this point to combat these levels of inflation.